Hi everybody. In this lecture we are going to focus on bonds and bond valuation. Here's a quick overview of what we'll cover. We're going to first go into some of the definition of bonds. What are bonds? And then I'll talk a little bit about issuers, and bond holders, who actually issues bonds and who buys them. And then we'll show some examples of bonds. And finally, we're going to talk quite a bit about how to value bonds. And our goal is going to be to apply the time value of money concept to valuing bonds. All right, so what is a bond? Well, we can think of a bond as a type of financial security instrument that's used to raise capital by an issuing party or by an issuer. A bond typically has the following characteristics. It has a principal amount, which is to be repaid on a specified date in the future. The principal amount is also known as the face value or the par value. The payment date is known as the maturity date. Many bonds have regular coupon payments paid out either annually or semi-annually or possibly quarterly. The coupon rate is the interest rate used to calculate the coupon payment and is a percentage of the principal amount. So for example, the coupon payment is calculated as the coupon rate times the principal. A bond is a legal debt obligation. So this is a key factor about bonds. If failure to make payments as required can result in legal recourse by the holders of the bonds. Right? If a company issues a bond, it needs to pay them off, otherwise bad things could happen. A bond may be callable by the issuer if under certain conditions the issuer decides it wants to essentially cancel all of the bonds. The callable feature lets it do that. So maybe after some specified amount of time, or if after some specified event, the issuer can essentially repurchase the bonds back from the market. Typically, the issuer will have to pay some kind of a penalty for this early recall. And then there are many other flavors and features that exist in bonds. So let me just continue with some terms here. There's a lot of new terms with bonds. The issuing party or the issuer, this is the party that has made the payment promises. We promise to pay the following. That's the issuer. The issuance of bonds is known as a bond offering. The holding party or the holder, that's the buyer of the bonds. That is the party who currently has possession of the bonds. So we can think of those as investors. The holding party receives the payments from the issuer. So if they're coupon payments or the final face value payment, those get made to whoever's holding the bonds. So typically, holding parties can freely sell their bonds to third parties and all the rights will transfer. And this takes place actively in bond markets. So basically, though, a bond is a loan, and that's kind of the simple way to think about it. Just to recap, so there's principal or face value, there's a maturity date, coupon rate, coupon payments, it's a legal debt obligation, bonds might be callable, there is an issuing party, there is a bond offering, there is a holding party, and who are these issuers? So bonds are issued by various types of parties. Again, these are trying to raise capital. So who raises capital? Through loans, essentially. Well, the federal government, right? They issue a lot of bonds when they don't have enough taxes to meet the budget needs. State and municipal governments, they may issue bonds for specific projects. Corporations issue lots of bonds. Money markets float bonds. You can have mortgage-backed or asset-backed securities. So there are a lot of different issuers to bonds. Who are the bond holders? Who are the investors in bonds? Well, these are oftentimes large buyers. So pension funds, right? Pools of money. Pension funds will invest in bonds. They want long-term stability, kind of low-risk securities. Insurance companies, the same thing. They want relatively low-risk investments. University endowments. There are bond funds. And even individuals might buy bonds. I just want to take a moment to talk about the magnitude of the bond market, at least compared to the stock market. Basically, the bond market is enormous. In 2009, the face value of total bonds outstanding globally was $82 trillion. In comparison, for equity, the value of stocks was $44 trillion. So it's almost twice as big, the bond valuations. By comparison, just to put this in perspective, total GDP in the world in 2010 was $62 trillion. And in the U.S., GDP was about almost 15 trillion, or nearly 25% of global GDP. So there was $82 trillion in bonds, about half that in equities, and all the global value created in the year was somewhere in between those two. So just to give you a sense of some big picture numbers here. The bond markets are really important, and sometimes they don't get as much common press because they're more subscribed to by institutions. So just they're really a large and important piece of the financial markets and the financial system as a whole. This is just a visual 82 trillion versus 44 trillion. These numbers are slightly bigger today, but the magnitude, the order of 2 to 1 it roughly holds. All right, so let me give an example now of bonds. We've been kind of talking conceptually. So a company wants to raise money for a project, and it decides to do so by issuing bonds. The characteristics of the bonds are as follows. Principal is $1,000. Maturity date is in 5 years. Coupon rate is 5%. And the coupon payments are going to be made annually at the end of the year. Let's just do a quick calculation on the coupon payment. That's going to be the principal times the coupon rate, which is $1,000 times 5%, or $50. So just know we're discussing the characteristics at an individual bond level. Right? The company is not going to just issue one bond, it's going to issue many of these bonds. So maybe it issues $1 million or $10 million of face value. Each bond is $1,000. So as a simple example, the company that is issuing, if you're issuing 1,000 bonds, each with $1,000 face value, that's $1 million worth of bonds. That's actually a very small bond offering. So now when issued, some bonds will sell for their face value. What will the market actually value them at? In this case, the company would convey the bonds, would give the bond to the buyer, and it would receive $1,000. So assuming the buyer holds the bond all the way to the maturity, right, he holds the bonds for 5 years, he's going to receive 5 annual payments of $50 and then a final payment of $1,000 after 5 years. In other words, the buyer receives the annual interest payments, and then the principal is returned. So again, that's pretty much like a loan. So now I had just said that some bonds are issued at their face value, right? It's $1,000 face, and when the bond is issued, maybe the buyer pays $1,000. But that's not always the case. In fact, it's rarely the case it's exactly what happens. Sometimes the issuing party is going to receive more or less than the face value. And really, it's up to the market. Kind of supply and demand determines a bond's price. So sometimes participants are willing to pay more than face values, and other times market participants are willing to pay less. So I want to talk a little bit about this and kind of what's going on with that. We can actually use the time value of money concept to help us understand this, which is very convenient. So the issuing party, the company in this case that wants to raise the money, specifies how much and when they will make the payments. We're going to pay $50 every year for the next 5 years, and then $1,000 at the end of the 5 years. That's what the issuing party announces to the world. And then the buyers, the holding parties, will assess how much value to put on that cash flow, that promised cash flow payment. All right, so it applies a discount rate. And you can do a time value of money analysis. So let's go ahead and do that. Let's just summarize this example. We've got a face value of $1,000 to be made in 5 years, coupon rate of 5%, annual payments of $50, and here's the timeline. All right, so this is exactly what we were doing in the time value of money calculations. We've got payments in year 1 of $50, year 2, 3, 4, 5. We get the $50 plus the $1,000, and we want to know how much is this worth today in year 0. What would you be willing to? What would the buyers be willing to pay? All right, well, let's kind of do some math here. Let's say we have a discount rate that's 5%. What happens? Well, we do our time value of money math. We can bring in a little spreadsheet. We've got years 0 through 5. We've got payments. This is just we're translating the timeline into an Excel version. So we got our $50 payments plus $1,000 at the end. We can calculate the present value interest factor for each year. So for example, for year 1, that's 1 divided by 1.05 to the first. For year 2, it's 1.105 to the second, and so on. And then we can calculate the present value of each yearly payment. So in 1 year, the present value is $48. The payment of $50 in 2 years is worth $45 today, and so on. When you add this column all up, you get $1,000. So it just so happens that a discount rate of 5%, which is equal to the coupon rate of 5%, means we're willing to pay $1,000 or exactly face value. And this is, again, we're just applying the time value of money mathematics. So based on the time value of money, we would be willing to pay $1,000 to receive 5 annual payments of $50 and a final payment of $1,000 in 5 years, assuming an interest rate or a discount rate of 5%. When just a little naming convention here, when the bond valuation or the price is equal to the face value, we say that the bond is selling at par value. That's just a term of the trade. So now what happens if the market applies an interest rate or a discount rate of 7%? So before it was 5 and now it's 7%. So how much would the previous bonds be valued at? All right, well, let's do our timeline here. So it's the exact same timeline, $50 for 5 years plus $1,000. And now we want to know how much is it worth today if our discount rate is 7%. Well, we can do that same spreadsheet analysis. These first 2 columns don't change at all. These are fixed. The present value interest factor, that will change. It's 1 divided by, the first term will be 1 divided by 1.07 to the first, and then 1 divided by 1.07 to the second. Right? In the previous example, it's 1 divided by 1.05 to the first, 1.05 to the second. So here it's 07. And we can calculate the present values. And you can see, if you compare it to the previous example, each one is a little bit lower than their counterpart in the previous example. And the total is lower. So we would be willing to pay $918 today for the same cash flow promised payments if we applied a discount rate of 7%. It's worth less to us as investors. I'll get into why in a moment, but let's just focus on the math for a minute. So now, just to summarize this, so based on the time value of money, we would be willing to pay $918 to receive 5 annual payments of $50 and a final payment of $1,000 after 5 years, assuming an interest rate of 7%. When the bond valuation is below the face value, we say that it's selling at a discount to par value. All right, so we went one way. Now let's see what happens when we go the other way. So what happens when the market decides the interest rate or the discount rate should be 3%? So how much would that same bond be valued at? All right, well, we'll start with the timeline. Again, this is all the same. The only thing that's changed now is our discount rate is 3%. So we can bring up our spreadsheet, and I'm just going to bring it all up at once. The only thing that, of course, the main thing that changes is this present value interest factor column changes. And now our present values are all a little higher. We value things in the future more highly. And we're willing to pay almost $1,100, $1,092 for this promised cash flow stream. It's worth more than the previous two examples, even though it's the same cash flow stream, because we valued the discount rate at 3% instead of 5 or 7. It's actually worth more today. We're really willing to shell out more money. So based on the time value of money, we would be willing to pay $1,092 to receive, those same payments, but assuming it's discounted at 3%. When bonds are valued above their face value, we say it's selling at a premium to par value. So let me just summarize this. We've got the same cash flow promise, right? The issuer is saying, I'm going to give you this. And then the buyers will apply a discount rate. So they apply a discount rate of 3%, and it was going to be, and they'd be willing to pay $1,092. If they applied a discount rate of 5%, it's worth $1,000, and maybe if they apply a discount rate of 7%, then they'd only be willing to pay $918 today. Right? So you can see as the discount rate is lower, the value of the bond is worth more today. As the discount rate is higher, 7% versus 3%, the value of the bond is worth less today. So this is the same mathematical principles that we saw earlier when we discussed the time value of money. So this is good. It's all consistent. And it follows pretty naturally from all those time value of money discussions. So you might ask, why would investors, why might they charge apply a discount rate of 3% versus 5% versus 7%? Where does this come from? And that is, of course, an excellent question. Right now, we're just being handed these discount rates. And in the next lecture, we'll get into a little bit, where does this interest rate come from? So hold on to that thought if you're thinking that thought. Let me just provide some conclusions of bond valuations. So we can use the time value of money to value a bond's price today. The time frame, the coupon payments, and the final principal payments are all specified by the bond issuer. These represent the future cash flow stream. This is the numerator of the time value of money, you can think of it as. The market then applies an interest rate or a discount rate to the above cash flows to calculate the present value of the bond's price today. I should say that's the numerator. So it's kind of like the issuer says, here's the numerator of the analysis, and the bondholder says, all right, we've got the denominator, and we'll bring it together, and we'll come up with the present value. So just some final observations about bonds. Valuing a bond is really the same as calculating the present value of an annuity and the present value of a single payment in the future. So, for example, we had 5 annual payments of $50 at a given discount rate, and then we had a payment of $1,000 in 5 years. So the value of that bond would just be the present value of the coupon payments plus the present value, which is an annuity, plus the present value of the face value, which is just a single payment. And you add these two up, and that's the present value of the bond itself.